Yes, hi everyone, and welcome to the next presentation, which is the final for the day. Together with us now we have BTS, the global management consulting company, and my name is Daniel Thorsson, an equity analyst at ABG. So with us from BTS, we have the CEO, Jessica Skoon. So I let you present the company, Jessica, for some 20 minutes, and then I will have a couple of questions in the end. So feel free to go ahead.
Perfect. Hello, everybody. Lovely to meet you all. Good afternoon. It's the morning time here in San Francisco, where I'm calling in from. Go ahead and hit the next slide. It's my pleasure to introduce BTS to you all. Our founder, who I took over as CEO in May of this year, our founder is now our executive chairman, but he started the company from traditional strategy consulting roots. But I would say from day one, we are a very different type of consulting firm. For 30 plus years, we've been focused on the people side of change, right? Business is a business of people, and I think you'll get to know that more through my examples in a minute. But in terms of just to give you a sense of our current strong kind of global position and competitive position, you can see our net turnover is 2.4 billion Swedish kroner. We have a 36-year track record. We went public in 2001. For those of you who are early investors, you've enjoyed 13% annual revenue CAGR, 17% EBIT CAGR, and 18% annual shareholder returns, which I think is pretty rare, right, in terms of over this couple decades. We have 1,200 people full-time across 36 different offices. We also enjoy a fairly big contractor or part-time network employee base, which gives us some freedom and flexibility and agility, right, as markets become more volatile. And over time, we have now 40 active clients who are amongst the Global 100 list and a little bit over 50 of the US Fortune 100 as BTS clients. Next, please. You can see our global footprint, where the offices are located around the world. About 50% of the business comes from North America. Second biggest is the other markets in mint green, and then we have Europe in purple. The way we run the company is 3 core operating units, so 3 P&Ls, North America, Europe, and other markets. And we also have a set of centers of expertise, which I'll share with you in a minute. Next. So I guess the question is, why is BTS growing, right, year over year in terms of the performance that I shared with you? I already talked about our strong competitive position to be large enterprise clients partner, kind of multi-year partner at the global level. It helps to have a global footprint so we can serve them both with their top company priorities, but also with a local flavor and local spin. The second reason is it's really fun to be BTS. And in the next few slides, I'll share with you how it's hard to put us just in one box. In terms of our competitor set and who we take share from and the types of client problems that we serve. But in a nutshell, we operate in a very global, growing, and highly fragmented market. Next, please. So in terms of the highly fragmented market, I'm going to start with the types of customer problems we solve and the different client budgets that our account teams are able to serve. So the majority of the company's revenue, let's say around 60% or so, is number one, which is going after the CHROs, chief learning officers, chief talent officers, so the general like HR training and talent market. And you can see some of the classic issues, right, that they are trying to solve. And in my most humble view, I would say training and that function in general has been probably mediocre at best, right, over the last 5 decades or so. And I think BTS is an incredible partner there, where we have plenty of end-to-end now leadership development and training partnerships. And I'll explain to you why we're different in a minute. The second client budget is chief revenue officers, sales enablement, so helping clients with their revenue targets and helping their sellers or the people on the go-to-market side of the business be better, right? Close bigger deals, bring their brand to their market base, increase their productivity, and so forth. And then the third one is selling to business leaders, line executives, P&L owners, chief transformation officers, strategy officers, CFOs, and CEOs. And there we, I think, are pretty different and unique in terms of helping to implement the strategy, as well as over time we've been asked to do more strategy creation work as well, and supporting them with their big change and transformation efforts. Next, please. Keeping the same framework, I've added at kind of inside the pink now some of the BTS's major differentiators. So if we group number 1 and number 2 together in terms of the overall training market, BTS's brand and our reputation and our growth has been driven by the fact that we're not theory, we're practical. We don't do just lecture-based training. It's all simulation and high-fidelity practice. So we help them establish high performance by critical role. We help all the leaders understand command of their evolving business model, the financials. We help them make better decisions. And we recognize that all clients are in a unique strategy position in their market with a unique culture and a unique operating model. And therefore, the training should be high fidelity. You can see our competitive landscape on the bottom left. So in terms of kind of this highly fragmented market that's growing, you've got the executive education programs for executive development and readiness, and they have phenomenal professors and great ideas, but in general, they're not practical enough, right? And our clients want to do C-suite readiness for the future of their firm. And what the executives of Nike need to do differently over the next 5 years is different than that of Salesforce, for example. There's plenty of mom and pop boutique firms, but their issue is that it's hard for them to scale. They tend to be not global enough, and their entire business model is framework out. There's the HR search-based companies that have grown primarily through acquisition into broader leadership and talent services, but they still tend to be more search first. And then you've got the tech first companies who we certainly learn from, and they have some great offerings and some great user experience and data collection, but the nature of their business model is to scale their software, which in its nature tends to be quite standard. And then on the right-hand side, we take share from what I would say the traditional consulting firms, because we just have a different approach, right? Rather than focusing on technology implementation or process redesign, our primary focus is to get everybody in the company aligned around the new direction and actually make the change happen. So that's our competitive set. We approximate that we only have 1% share in both groups, and the TAM is probably well over 30 billion. So if we double click now into the offering, so next slide, please. Thank you. So the most differentiated BTS capabilities are in this slide and the next slide. This is, as I've mentioned before, our modeling abilities and our simulation abilities. So we are phenomenal at simulating potential growth strategy options to help in the strategy creation process. And then in terms of implementation and getting people to do the best work of their lives on point with the strategy and the financial plan, we model strategies, business models, entire enterprises, cultural moments, BUs and functions, workflows, financials, high-performing critical roles, and so forth. And I'll leave you with this idea for this particular one, but if you think about any other high-performing team in the world, the football that we're watching in the World Cup right now, those players practice more than they perform. It's part of being world-class, right? It's part of being great. It's part of being exceptional. Militaries practice more than they perform. Companies, in general, don't practice enough. They're not even close to that same ratio. They probably don't even give their people 1% of their time to practice. So little by little, we've been shifting this paradigm for 30 years, because when practice is exceptional and it makes somebody realize this is how to be great at my job, and this is what our strategy means, and this is how we make money, and so forth, they tend to be better performing and the company gets better results. We're also really good at mindset shifting. It's hard to change a person if you can't change their underlying beliefs. And so our entire content library is based on that. And then we do a broad set of advisory services as well, more on the organizational change side. And there, I would say the biggest feeling difference in BTS is that if the clients keep the authorship, they keep the ownership. We're not the firm that just tells them what to do and hopes they do it, but we don't think that actually works very well. So our process and approach doing the advisory and the consulting work also feels different and empowering. Next slide, please. This is our breakdown of the different areas of expertise or practices that we have in the company. So everything from strategy alignment and business acumen to change and transformation to innovation and digital transformation, leadership development, executive presence in teams, sales and marketing, assessment coaching, and diversity, equity, and inclusion. And I would say over time, we took more of these like deep dive solutions to market, but in the last 5 years, we've been doing a really good job of pulling the different IP services, simulations, experiences, and tools across the board to be a broader partner for our clients, which means our average deal size has been going up. Next slide, please. We've also invested for quite a while now on our own digital transformation and digital services. For those of you who've been following us for a while, you know how much that helped us in 2020. But we continue to do our services both virtual and in person. We think that mix will continue. There's a lot of pros to having both. In general, about 11% of our global revenues is licensings, and we typically get larger license deals from our clients in the following, or for the following reasons. Number one, at scale partnerships. So you can see the example there. We worked with a client a few months ago. We have a new sales methodology. We need to get all 30,000 people to understand it and to start to show up to customers differently in terms of how they team and how they talk to customers. So we believe the most effective way of doing that is to actually allow them to practice, right, through simulation. So we delivered a simulation to 30,000 people over 24 hours globally, and that was the beginning of ongoing practice and behavior shift. But in that type of need, it's better to use more of the client's leaders to do the implementation, and that's where the licensing comes in. The second box there is on the leadership and learning side, there's a general push to, we want to democratize learning, and it needs to be more personalized and practical to the individual. And there's a general, I would say, disappointment by chief learning officers from their investments in the large content libraries. The usage is not very high. Why? Because it's not personal and practical enough. So we've been asked to do more re-architecture of broad learning and leadership approaches and the functions. And part of that is our clients then licensing some of our mindset-based tools and micro simulations and so forth, which are more practical. And I think I mentioned the third one already, which is the more we can get our clients' leaders to do the change through their meetings, through their own time with their teams, the better, the more likely it is that the change happens. And so that's another moment when clients will license our methodologies and experiences. So if you go to the next slide, we also have a history of inorganic growth, and that will continue. We've typically targeted, 1 a year or 2 a year, something like that. So we're a little bit behind right now in the next acquisition. And, but in general, I would say in the past, there's been 2 things that have been true. It's given us geographical expansion. And the second thing is a new service offering, right? Or filling a capability gap. For us, we tend to focus on small to mid-sized businesses, kind of that mom and pop category I mentioned before. Why? Because those companies also put themselves on the market for sale. I think they tend to realize that they've been successful, but if they want to have global expansion, they need to be part of a broader firm. And of course, we're looking at the quality of the talent as a culture add to BTS as well. Next, please. And look, we're at a really interesting size right now, and it's time to take advantage of our scale from multiple different angles. So in terms of what I'm working on globally is we have amazing client partnerships that in one client, we serve all 3 of the different buyers, and we have a really strong brand, and we advise the CEO and so forth. And so it's just simply a matter of scaling those client examples around the world across our 36 different offices. We're working on taking we've been very, very entrepreneurial at the local level, which is awesome. It means we have very high tenure of our best leaders and our best account managers because they feel free to do what's right for customers in their local market. At the same time, we have pockets of expertise around the world. So taking those experts and making them more of a real-time global support resource rather than more locally focused I think should help us. And redesigning our knowledge management apprenticeship approach. As I mentioned already, we have 600 contractors. A decent percentage of our COGS, for example, in the US, I think we would be close to 9 million spend this year on using external talent. So if the market softens, it's easier for us to kind of pull back on spend there and use our full-time talent to do some of the work. We've been working for a few years now on digitizing all of our center of expertise content and tools, so it's easier to implement and easier to implement at scale. And there's certainly been, given I mentioned the local freedom, there's been a lot of energy from our local country heads to simplify and do more things kind of one global way, which when we help our clients with this shift, typically the people who have all the freedom don't want global or central pushing their ways on them. I'd say right now at BTS, they're actually asking for consistent client campaigns that they can leverage. So it's a little bit more support from global to make their lives easier and give them more time to just be with customers. So Philios and I will be working on that. Next slide, please. The other big differentiator for us is the BTS culture, which I would say is the third point on here. And I experience it. I mean, I've grown up here, so it's one of the big reasons why I'm still here. But I would describe it as high performing, right? We want to hit our quarterly numbers, and we're oriented that way. At the same time, we're fun loving, right? And I would say we're big hearted. So we tend to take a long-term view through market softening, and every time we've done that, it's been in our favor because we've popped out the other side stronger, and we've needed more people than we had going in. But our clients notice it. That's maybe the most important thing. Acquisition candidates notice it, and it gives us a very advantageous spot in a multiple bid moment. But the customers notice it. To give you a sense, just in the last 2 months, I've been asked by 8 CEOs to meet with them who have experienced our work, and they asked me one question. We want to know about the BTS culture. So I thought that was worthy of sharing with you as well. But in general, we're in a strong position with our global offices at this moment in a large, growing, and fragmented market. We have a long track record of high performance, right? And we have a clear plan for both acquired and organic growth. And our culture that got us as far is certainly strong, and I will nurture that and will continue to drive us forward. And if we look at the financials of the last quarter, then I can open it up for questions. In Q3, we had 12% growth. You can see kind of the details on the right. So 12% was currency adjusted, 29% revenue growth given the strong currency advantages right now for us. And 10% of the 12 was organic growth across the units. The reason for the slower growth of 12 or 10 of organic, it was North America, as I mentioned, went to 1% growth in Q3 due to a handful of our software clients who at the time back in May and June were either unprofitable or cash flow neutral, and they froze. They froze when their market valuations tanked, and their investors created a new plan to profitability for them. The good news, as I mentioned on the last report, is that the majority of them are back to being our clients now, and we're progressing forward. So, but in the third quarter, Europe and other markets in APG continued with really great growth, double-digit growth, and improved profit. We will continue to invest in digital to meet those scale and personalized demands of our clients. And moving forward, I mean, we started middle of this year to kind of be recession ready, right? And which helps us whether or not it comes and in whichever strength it comes in. But we've been focusing both on industries and clients with CEOs who we believe will continue to invest in having their people being more agile and high performing in a more volatile market. So, and finally, if you go to the next slide, please. As you may have read, our outlook, we have an unchanged outlook for 2022 compared to what we said in the second quarter. And so we believe that earnings this year will be significantly higher than in 2021. So thank you all. The sun is coming up over here, and I'll open it up for questions.
Excellent, Jessica. Thank you very much for that. I start off with a question related to the financials that you mentioned, the 1% growth in North America in Q3. Have you seen that coming back to decent growth rates again with the US software clients that you mentioned froze kind of overnight in Q2 and Q3 here?
Yes, I mentioned that in the last earnings call. Yes, almost all of them have come back as active clients. So it's like they took basically a couple months of being frozen and then readjusting their plans and so forth, and now they're active clients again. And so the North America's rebound, and specifically the software clients' rebound in the fourth quarter, is one of the factors that we're confident in our earnings being significantly higher the next year.
I see. What about the rest of the US then, except the software clients? Have you seen any slowdown in other industries or other end markets in the North American business?
We had 2 clients in our central area. So think about it as West is 1/3, Central is 1/3, and East is 1/3, essentially, of our total US revenue. We had just 2 clients who stopped initiatives, but that's not enough to be material, right? We tend to, every quarter, have a couple of clients who delay or change their mind on something. So that's still within the margin of error. So no, we haven't seen it yet.
Okay. Interesting. And then looking at the other 2 regions, Europe and other markets, you mentioned them, they were growing more than 20% each in Q3 here. Have you seen any signs of slowdown there in Europe? For example, we're seeing the German economy going a bit slower, etc. Or should we kind of expect them to continue the growth?
Yeah, it's similar to my last answer with the central market in the US. There's been a couple customers who have changed their plans for next year, but it's not material enough yet. But yes, I share your concerns in general, right, for the German market and the higher energy costs and so forth. But yeah, so.
Okay, so no material effects you have seen throughout Q4 at least. Okay, interesting. And then going into 2023, I think this is probably the most expected recession in a very, very long time. Does it mean that your clients, the companies, are going to reduce spending on external costs like consulting, or are they actually demanding even more now to know and prepare on how to operate in next year so that your January kickoff pipeline looks even better? Or how should we think about 23, or the start of 23 at least?
That's exactly the question, right? And that goes back to us understanding CEOs' views of how they lead and how they run their companies when they're in fear, right? Or when they're in a contracting market. There's no doubt that our company's costs are going up, right? And so they will make adjustments in consulting spend or in spend in general. At the same time, our biggest growth right now in our pipeline for Q1 is coming from company kickoffs. Sales kickoffs, top 300 meetings, top 100 meetings, exactly to your point, because now's the time to over communicate around how to be agile, how to sell in a recessionary and inflationary environment, any shifts they want to make operationally, cost improvement programs they want to run. So it's a mixed bag, right, in terms of how companies look at the moment. And but in general, it's good to be a consulting company in these moments. I would say, going back to our portfolio, if you look at L&D and learning spend, it's the more commoditized part of training that tends to get canceled. And as you move up in the organization, so the training that's most aligned to a shift in direction, or you move to revenue growth initiatives or big change initiatives, those continue to get funded.
Yeah, I see. You also, sorry, you also mentioned that you are more recession ready yourself now as well, and being prepared for end markets, how they turn out. How does it affect you in the labor markets and net recruitment here? Are you a little bit more cautious on hiring people across your offices, or are you still kind of positive and opportunistic in doing that throughout Q4 here and into 23?
Yeah, so we were behind in hiring coming out of 2020, and we've caught up by the middle of this year, including the people who started in Q3 with the offers. Across the 3 markets, we feel like we're well staffed, and that's a new feeling and it feels good. So in June, we hit the pause button on hiring around the world, actually, to kind of see how the markets would play out in the 3rd and 4th quarter and moving into next year. So I think what we'll do is we'll be conservative, very conservative on the cost and hiring side, at least for Q1, and we'll see how that plays out, and maybe even for the entire first half. At the same time, we don't want to shoot ourselves in the foot, right? Every recession, we wish we had hired more during the downturn than we did, and we were always understaffed. So we will be conservative, and we'll let our own growth, right, and our ability to grow and focus on the right accounts dictate when we open up the hiring again.
Okay, I see. That's interesting. And then finally, on the M&A side here, we concluded that you haven't done any acquisitions in 2022. You are still looking at smaller firms, competitors, or complementary products and technologies. Are the prices not low enough, or are the sellers not really there because they haven't seen any slow in demand? Or kind of what are the triggers for you to complete a couple of acquisitions here?
Well, we have to be excited about what's for sale as well. So we've looked at a lot in the last 6 months, and out of a lot, we were really only excited about a few. And even in the due diligence efforts of a few and a couple issues, the founders wanted to leave and retire. And if we're going to bring in a new capability of the company, we need the leaders to stick around, at least to have successors in place. So we kind of dropped the interest in that. One of them, I was shocked by the valuation of a private equity competitor. So in terms of our valuation of the company, we gave the offer at what we thought would work, and they went in significantly higher, and good for the founder. I don't have enough examples. That's an N of 1 where the price was very, very high in terms of valuations. I imagine they're going to come down, right? So next year could be a great year for us to take advantage of that, but that needs to happen, and we need to find the right firms.
I see. I see. I have time for a final question. Then you are an employee-intense company, lots of employees, obviously. How do you look at salary inflation in 2023 versus hourly prices going up, etc.? How can you mitigate that cost inflation to maintain margins?
It's all about pricing, right? And having a systematic approach to increasing pricing, having the confidence of our account managers with their customers to do that. I think we've done a good job of increasing pricing the last 2 years. The general sense that customers are becoming more price sensitive after 2 years of price increases in general, but our services are so broad that if you go back to that chart, as you move from the left to the right, the price sensitivity gets a lot less. So we need to take advantage of those opportunities. I think our markets are a bit different also in terms of the inflation rates right now and the percent raises we've given in the different markets over the years. So moving into next year, probably Europe and most of the world need a bigger bump in terms of salary raises, with North America being, I think we can be a bit more conservative. But we don't give our salary increases until March, so we've got some time as well to see how the market plays out and see how the first couple months of the quarter go for us.
Excellent. Thank you very much for the time, Jessica. Very interesting times, and we look forward to look at the Q4 report in February.
Super. Thank you
Thank
for
you very
including
much.
us.
Have a great day.
Good day.